Harvard Business School did a study that should make every stock picker uncomfortable. They compared the most volatile stocks on the market against the most boring ones over decades. The boring stocks won, not by a little, by several percentage points a year. So if you are chasing high beta stocks for bigger returns, there is a very good chance you are playing a game that is rigged against you. Unless you understand the one thing most people miss. First, let me make sure we are all on the same page. Beta is just a number that tells you how much a stock moves compared to the overall market. The S&P 500 has a beta of 1. That is the baseline. A stock with a beta of 2 moves twice as much. Market goes up 10%, that stock goes up 20. Market drops 10%, that stock drops 20. A beta of half means it moves half as much. Slow and steady. High beta stocks are the roller coaster. Low beta stocks are the escalator. Most people hear that and think, great, I want the roller coaster. Because bigger moves mean bigger profits. And that is where the trouble starts. Here is where it gets interesting. Harvard Business School ran one of the most comprehensive studies on beta ever done. They split the entire market into thirds. The lowest beta stocks, the middle, and the highest. Over extended periods, the lowest third outperformed the highest third by several percentage points annually. Let that sink in. The stocks that move the most, the exciting ones, the ones that feel like they should make you the most money, they lost to the boring ones. This is called the Low Volatility Anomaly, and it breaks the most basic rule of finance that more risk should equal more reward. So why does this happen? 3 reasons. 1. The market systematically misprices volatility. People overpay for excitement. 2. High beta stocks carry hidden risks that the beta number does not capture. 3. Behavioral bias. Investors are drawn to lottery tickets. They want the 10x moonshot and are willing to overpay for the chance. Sound familiar? Because that was me. In 2018, I was buying the most volatile things I could find. Crypto coins, nobody heard of. Leveraged positions, stocks that move 10% in a day. And I thought that was the game. More volatility, more opportunity. Except I had no idea what was driving the volatility. I did not understand the fundamentals. I did not understand the catalysts. I did not even understand the position sizing. I just saw a line moving fast and wanted to be on the ride. That is the trap. High beta is not the risk. Ignorance of what drives the beta is the risk. It is the same principle Buffett talks about. Risk comes from not knowing what you are doing. The stocks did not change. I changed. I started asking, why does this stock move this much? Is it the sector? Is it the balance sheet? Is it sentiment? Is it structural? And once I could answer that question, the volatility stopped being a threat and started being a tool. Let me show you what I mean with real examples. Financial services stocks like T. Rowe Price, beta around 1.53, or Blackstone beta around 1.66, or Apollo Global beta around 1.60. These move a lot. But why do they move a lot? Because they are tied to interest rates, market sentiment, and asset prices. Not because the businesses are broken. When the economy expands and rates are favorable, these companies print money. When the cycle turns, they pull back. That is a fundamentals-driven beta. You can understand it. You can time your entry around the economic cycle. You can hedge with options. Now compare that to a random small-cap stock with a beta of 2.5 because it has no revenue, a questionable CEO, and it moves on tweets. Same high beta number. Completely different risk profile. Sector context tells you whether the volatility is a feature or a flaw. Material stocks like Albemarle, beta around 1.63, move with lithium prices and EV demand. That is a macro bet you can research. A meme stock moves because someone posted a rocket emoji. Know the difference. Now here's where high beta gets genuinely interesting for someone who understands options. High beta stocks have higher implied volatility. That means their options are more expensive. But here's the flip. When a high beta stock is sitting in a tight range, consolidating, doing nothing, the implied volatility drops. the options get cheap. And if you have done the fundamental work and you believe a catalyst is coming, you can buy calls at a discount that the market is basically giving you because everyone got bored and stopped watching. This is exactly how I approached Tesla LEAPs and MicroStrategy. Not because I was gambling on high beta names. Because I understood the thesis, I understood the catalyst, and the market had priced the options as if nothing was going to happen. When it did happen, those cheap options turned into outsized returns. That is the edge. High beta combined with low implied volatility combined with a fundamental catalyst you understand. Not advice, that is my framework. Your trades are your own, so here's the practical framework. Before you put $1 into any high beta stock, answer 4 questions. 1. Why is the beta high? Is it sector-driven, macro-driven, or is the business itself unstable? If you cannot answer this clearly, do not touch it. 2. What is the catalyst? What specific event or trend do you believe will move this stock? If the answer is, it just moves a lot, that is not a catalyst, that is a lottery ticket. 3. What is your downside? How much can you lose if you are wrong, and can you survive that? Position size accordingly. Never risk more than 2 to 3% of your capital on one high beta play. 4. What is your exit? Not just your profit target. Your time horizon. High beta stocks can sit sideways for months. If you do not have a time frame, you will either panic sell at the bottom or hold through a move that was never coming. 4 questions. If you can answer all 4 with specifics, you have an edge. If you cannot, you are the one providing the exit liquidity for the people who can. Let me give you the landscape for 2025 because context matters. We are in an environment where interest rates are in flux. AI is reshaping entire sectors and geopolitical uncertainty is elevated. That means volatility is structural, not temporary. Financial services stocks will keep moving with rate decisions. Material stocks will keep moving with EV adoption and commodity cycles. Tech stocks will keep moving with AI regulation and adoption curves. This is not a market where you avoid high beta. This is a market where high beta is everywhere. The question is not whether to engage with it. The question is whether you engage with it as someone who understands it, or someone who is along for the ride, hoping it works out. The Harvard study says most people are in the second group. The opportunity is being in the first. Let me be real with you. Most people should not be concentrated in high beta stocks. The Harvard data is clear. Over long periods, low volatility strategies have an edge. If your plan is to buy and hold an index fund for 30 years, you do not need high beta in your life. That plan works. But if you are the kind of person who wants to understand how the machine works, who is willing to do the research, who wants to use options and position sizing as tools, not gambles, then high beta stocks become one of the sharpest weapons in your arsenal. The key word is understand. You do not trade high beta because it is exciting. You trade it because you have an information edge that the market has not priced in. When you have that edge, the volatility is not risk. It is opportunity. When you do not have that edge, the volatility is not opportunity. It is a tax on your excitement. Know which one you are. So the next time someone tells you a stock is risky because the beta is high, ask the question they did not. Why is the beta high? Is it a business you understand in a sector you have studied, with a catalyst you can name? If yes, that is not risk. That is a setup. If no, walk away and find one where you can answer those questions. The beta is not the enemy. Ignorance is. And that is fixable. I am building a community of people who think this way. Patient, informed, hunting asymmetric bets. Small risk, big upside. Follow Wealthy Beaver on X. Learn the game. I want to see you win.